It's great to be here today. The theme that we'd like to explore in this next session is around impact management. Just as context for those who may not know of Bridges Ventures, we were founded 15 years ago. We invest in the UK and the US and also in Europe in 3 investment strategies: property, growth equity, and then social sector. So that includes areas such as social impact bonds. Now, there's been fantastic growth in investing for impact in recent years. It's great to see. But at the same time, the challenges that we tackle are huge. And also we see a lot of asset owners intrigued, but not yet committing. Now, there are many reasons for that. One is, for example, the lack of scaled investment product. But what we'd like to suggest this morning is that a fundamental reason is that actually there isn't a clear understanding of how impact can be managed. Now, if we look at impact management, what do we mean by it? Well, fundamentally, it's about understanding expectations. Expectations on who are we looking to help? What are the challenges? What outcomes are we seeking? What are the risks involved? And that's actually quite different, therefore, from impact measurement. There's been a lot of focus in recent years, and rightly so, it's really important, on how do we measure impact. But without an understanding of how do we manage it, it's actually hard to measure. So if we think about the analogy with the capital markets, in the capital markets there's a shared convention, and it's a convention that's shared through all of the players that we can see here, right through the chain. And those are expectations about return, liquidity, risk. So for example, if a client walks in to talk with an investment advisor, say UBS or Charles Schwab, or many others around the world, they'll probably walk through a fairly standard set of questions. And those allow the advisor to get an understanding about what the expectations are of the person who's looking to invest. Now, if that conversation then comes on to impact, they might be met with a blank stare. They might be met with a warning, oh, I wouldn't do that, that might undermine your returns. They might get some suggestions of microfinance debt or maybe a negatively screened investment fund. But there isn't yet that same shared set of expectations and that language for how to discuss them on impact. Just as context, Bridges has a dual mission. So on the one hand, we are an investment manager who invests for impact, but we also have an explicit purpose of contributing to the growth of the sector in which we all work. Over the years, therefore, we've been asked by many organizations for support and guidance on how to integrate impact, and we're very glad to help with that because it grows the sector. What we've been hearing, though, through many of those conversations in recent years is there's a lack of this understanding about how we manage impact, and therefore we are asked to convene a project. It's called the Impact Management Project, to do that. So round the table, there are leading foundations. There's the Omidyar Foundation, the Ford Foundation, for example. Also leading international groups like DFID, asset owners like PGGM, investment managers like UBS and BlackRock. But crucially, this is an initiative that's for the public good, totally transparent and inclusive. And so in a moment, I'll talk about how the project is running. But the aim of this project is to come up with that shared framework. So when I talk about framework, this is the heart of it. Imagine that we're clients and we sit down with our investment advisors and we could talk about the impact that we're aiming to achieve from the businesses or assets in which we invest. And that's the vertical axis there. We might want to just avoid harm, or actually we might want to really tackle pressing challenges. And in between, we might want to just make sure that we're making good investments, but that aren't at either extreme. On the other dimension, the horizontal dimension, we've got the expectation on the role that our capital plays. And this is really important because one can think over on the right-hand side about actually wanting to catalyze new solutions, new ways of tackling pressing challenges. And down on the left-hand end of the spectrum, one might just want to signal one's support for trying to avoid harm. So, for example, if you're investing predominantly in a listed equities fund and you want to signal that you want to avoid harm, you might actually ask your investment manager to vote against corporate activities that are harmful. And that framework is actually very powerful because then it allows the client and the investment manager, or the asset owner and the investment manager, to come to a shared understanding as to what the portfolio should look like to meet those expectations. So just to give one example, one of the investments that Bridges has most proud to have made is in a company called the Gym. Now, the way that Bridges works is we start by saying, what is the challenge? And then working back from that to the investable solution. So here in the UK and in many other countries around the world, there's a growing problem of obesity. And there's a huge cost from that. Now, as one works back to say, well, what are the reasons for that? There are many. It might be nutrition, it might be education, but also access to health options and, crucially, sort of fitness options. Now, as one then drills lower, what one sees that here in the UK is that many of the gyms have minimum contracts, often of a year. They're fairly highly priced. They might be in locations which are different from where people who suffer from obesity are located. And therefore, we saw the opportunity for essentially an easy jet of gyms, a low-cost gym. We looked around in the UK. We couldn't see that at the time. And we looked, therefore, outside the UK and saw early indications of the viability and success of that business model. So that was a pressing challenge, and we decided to catalyse it, so over on the far end of that spectrum, with an investment. We formed a management team and launched the company. That then grew, and just to give you an indication as to how it works, it's a monthly membership, $17.99 a month, very affordable. You just click in and click out like you're going on the underground. So it's a low-cost but high-quality gym. As it grew, it needed more capital. So we then invested a second round. Now, at this point, our capital was less catalytic, and it was more about influencing, about growing the sector. So I just give that as one example from Bridges' experience. We exited the investment as a very successful investment, financially, but also from an impact perspective. But you can see on this framework how if, for example, you're an investor who also is concerned about obesity, but one wants to start from the point of just avoiding harm, and you're invested, say, in listed equities, then you could ask your investment manager to invest in companies that are helping to find solutions, maybe downweight or underweight those companies which contribute to very high calorie diets. So that's the heart of this. In terms of the overall project, well, we're right in the midst of it at the moment. The next couple of phases are open to all. And crucially, what we're doing at the moment is convening a series of discussions around key topics of how impact is managed. Those are open to people across different asset classes, across geographies, right through the value chain, NGOs. We want this, for a language to flourish, it has to be developed and understood by as many people as possible. So we're at the moment where through those discussions, gaining an understanding of impact expectations, where the common ground is, and how we can build on that. That will then enable us together to come up with examples, model portfolios to illustrate this in practice. We've just given one example today with one investment, but you can imagine how that can be applied across a portfolio. And then as we move towards July, actually showing how the existing standards, frameworks, measurement techniques, which are excellent, can together link via this convention to actually enable it to be implemented. So that if we go back to that example, a client sits down with their investment advisor, they can have a really informed discussion to understand expectations and then apply them to construct a portfolio through which impact can be managed and measured. So that's the impact management project in essence. Some of you may already be participating, in which case thank you very much. If you're not yet, we'd really encourage you to get in contact with me at Bridges or with the team, because this will fly when it has the input, the challenges, the questions from as many people as possible. So in summary, therefore, there's huge potential for the area in which we work of investing for impact. And quite frankly, it needs to fulfill that potential to address the challenges we face. But we'd suggest that it will best be able to do that when there's a shared convention for understanding and then applying how impact can be managed. Thank you.